Today I will talk about business taxation. My name is FAHAD ALSHARANI.
Presentation on the Irish taxation system. The Irish taxation system is considered to be one of the most progressive tax systems in the world. Prepare a presentation on the features of a progressive tax system and discuss whether these can be observed in the Irish taxation system. Illustrate your presentation with specific examples. Progressive tax system. Progressive tax is the taxing mechanism in which the taxing authority charges more taxes as the income of the taxpayer increases. A higher tax is collected from the taxpayers who earn more and lower taxes from taxpayers earning less. In this way, the government uses a progressive tax mechanism. Under progressive taxes, it is believed that people who earn more should pay more. The income tax is divided into slabs. As the income of the taxpayer crosses a benchmark income, a new rate of tax, higher than before, is charged to him. Progressive tax system. A theory behind progressive taxation states that persons or corporations who earn the same or a similar amount of money should be taxed in the same or a similar way. For example, the theory states that two individuals making $50,000 per year should be taxed the same amount, regardless of how they earn their income. This is known as horizontal equity. While most countries have some form of progressive taxation, it is usually coupled with other taxes, such as a sales tax, and few countries treat all income as exactly the same. Irish taxation system. Ireland has the most progressive income tax system, including employee social insurance contributions, in the EU. The tax paid by a single person on two-thirds average earnings are just under €35,000, is the fifth lowest in the OECD, out of 34 countries, after Mexico, Chile, Korea and Israel. The tax paid by a single person on average earnings is the 27th highest in the OECD. A single worker on an average income pays about €14,600 in income tax and social insurance contributions in Belgium compared to over €6,850 in Ireland, a difference of over €7,750. The tax paid by a single person on 1 and 2/3 average earnings, €58,000, pays €18,700 in tax, which is slightly above the OECD average. A person at the same income level in Belgium would pay €28,500 in tax, just under €10,000 more. Irish taxation system. A major reason for the relatively low direct tax burden in Ireland is that PRSI is lower here. In many countries, PRSI funds pay related unemployment and pension benefits, while the Irish system provides flat-rate benefits only. Irish employees and their employers have to fund supplementary pensions separately. For example, Irish employees pay about €2 billion after tax relief towards their pensions annually. In many higher tax countries, these are funded through the tax system. The OECD figures they cite don't actually refer to tax systems at all. They use a very narrow measure, income tax paid by someone earning €55,000 compared to someone earning €22,000. Be that as it may, they undeniably refer solely and specifically to income tax. A tax system means corporate, capital, income, property, wealth, value added and every other form of taxation. Income tax in Ireland is, in terms of the revenue raised, just 41% of the tax system. A claim about that 41% is being systematically converted into a truth about the whole system. However, arguments have been proposed that Ireland's tax system is not progressive. Citing research from the Nevin Institute that the bottom 10% of people, by gross income, pay nearly 30% of their income in indirect tax, as opposed to the top 10%, who only pay 6%. However, there is a fundamental problem with this analysis. The appropriate base for indirect taxes is total expenditure, since richer households typically spend less than they earn. The use of total expenditure as a base would show a very different picture and reveal indirect taxes to be considerably less regressive than the Nevin Institute analysis. Presentation on Irish company law. The directors of companies in Ireland have significant responsibilities and duties allocated by the Companies Act 2014, and other sources prepare a presentation outlining the key duties of company directors in Ireland, including the directors' fiduciary duties and those established by the Companies Act 2014. Fiduciary duties of a director: to act in good faith, in what the director considers to be the best interests of the company, to act honestly and responsibly in relation to the company's affairs, to act in accordance with the company's constitution, and to exercise powers only for lawful purposes, not to use company property for their own or others' personal gain unless approved by the company's members or agreed to in the company's constitution, not to fetter discretion unless permitted by the company's constitution or entered into in the company's interests, to avoid conflicts of interest, to exercise care, skill and diligence, and to have regard to the interests of the company's members. General duties of directors. Directors must ensure compliance with the Act and the various tax acts. Directors must ensure that the company secretary is suitably qualified. Directors must acknowledge the existence of their duties by signing a declaration to that effect. Directors must take into account the interests of the members of the company and have regard to the interests of the employees. Restrictions, benefits of the codification of directors' duties. The codification of directors' duties in one place will greatly assist directors in identifying what is required of them. Directors must disclose any onerous responsibilities by the directors under the Act, and the chance of directors being any personally liable for their actions. It is imperative that directors are fully, but no obligation arises if the shares held represent less than 1% of the share capital of the company, or the shares do not have voting rights. Conclusion. This codification of directors' duties is a welcome inclusion in the Companies Act, as it removes ambiguity surrounding the duties owed by directors and provides a centralized reference point for directors in considering their duties and responsibilities in respect of their position. Such centralized documentation of directors' duties was up until this point notably lacking in Irish company law. The clarification of these duties and the requirement, where applicable, for directors to include a compliance statement in their annual report to include confirmation that the directors have taken appropriate steps to ensure compliance by the company with its relevant obligations, including the Companies Act and tax legislation, is likely to focus the minds of directors on the issue of compliance and the responsibilities of their role as directors.